Okay, this is your market close bomb blast for the day. And it was quite a bomb blast for equities today. Markets were down considerably today. First, I'm going to run through the numbers. Then I'm going to talk about why markets might have been down today and what comes next. Let's start with the indexes. The S&P 500 was down 1.66% on the day. The Dow was down around the same, 1.65%. Now, that should be interesting to you, right? Because the Dow typically does not shadow the S&P 500, but we've seen some very interesting trading between those two indexes lately. And you want to pick us up tomorrow when we do the weekend wrap up, because I'm going to talk a little bit more about the interesting dynamic between the industrials and the broader large cap indexes and some of the interesting phenomena that we witnessed over the past week and actually the prior week as well. So pick us up tomorrow and over the weekend, and we're going to be covering that in a couple of videos. Next, let's go to the NASDAQ composite. That was down 2.29%. I'm sure you're already picking up on the pattern here. And the Russell 2000 down 2.86%. Now, that should also sort of ring a little bell for you. We're going to cover that in 1 second. 10-year yields were up 5 basis points. That means 10-year bonds, 10-year treasury notes went down today. Now, when you have a risk-off day in equities, you typically find that bonds trade up, right? Because people sell their equities and then they buy bonds and that pushes yields down. But the opposite has occurred. So bonds fell today, as did all the major indexes. Let's talk about, first of all, why that might have happened. Okay. Well, there are a couple of interesting news items for today. First of all, we awoke to news that President Trump signed back into life the government last night while we all slept. And we would have expected that to be received as very positive news. But in fact, it was not, right? So markets really were under pressure for the majority of the day because there has been a growing tension around these high-tech growth stocks that really have dominated this year's gains so far. And now fears that we're going to start getting these economic data points that we have not gotten while the government was closed. There's a fear that maybe those data points, as they start to bubble in, and we don't know exactly when they're going to start bubbling in, might start to give us some news that might go against what we all hope for next month out of the Federal Reserve. That brings me to the Federal Reserve. So the Fed has been a real challenge this week, right? You're starting to hear a lot more negative talk from Fed governors, specifically from some of them that we're not expecting to hear it from. So the sort of market sentiment around next month's potential rate cut is somewhat souring. And today we got a little bit more of that Fed speak that kind of put a little bit of a damper on any kind of tailwinds that the market might have had. And so that sort of caused a couple of interesting things to happen, right? That kind of pushed to 10-year yields up a little bit in anticipation now of a lesser probability of a 25 basis point rate cut next month. Now, looking over at Fed funds futures, I see now there's roughly a 50% probability of a 25 basis point Fed rate cut next month. Probably this morning, that was something closer to 67%. That has been coming down. Actually, that came down significantly after the last Fed meeting, where Chairman Powell was kind of talking a little hawkish, saying that next month's rate cut is, not a guarantee. And so that has been sort of pegged in the 60 to 70 range. And right now it is at 50%. In fact, prior to the close, that was below 50%. And from Wall Street's perspective, those numbers below 50% are, likely but not probable. So these, at this point, I'd say it's a coin toss of whether or not we're going to get rate cuts next month. And that was a big sort of damper that overshadowed the markets today. That's why you see 10-year yields going higher. But also that is most likely what caused the Russell 2000 to fall by 2.86%. Remember, I told you there's a little hidden message in there. Well, the Russell is very, very sensitive to interest rates, and the Fed partially because of reality that a lot of those smaller companies do rely more heavily on debt. And when you start to see, rates go higher, that supposedly has a negative drag on those stocks. But that index nonetheless has become very much intertwined with hopes of Fed rate cuts and hopes that those fade away. You can see the index going up and down in a big way. So that was down 2.86% today. And that really was sort of the mood that, soured the market today. If we look over at the heat map, which I have behind me, and look at some of the notable losers, right? I'm sure you're not surprised to hear that NVIDIA was down 3.58%, and Broadcom down 4.29%, AMD down 4.22%. AMD just had some great news the other day, a great rally yesterday. And so, those stocks which typically dominate that growth trade and the IT sector, those are down significantly on the day, as you would expect. But I want to take a step back. Remember, these are high beta stocks. That means they do great when the market's going up and they do really badly when the market's going down. And those stocks happen to be the ones that are on investors' minds lately because of the high valuations and because the possible rotation out of those stocks earlier this week into more safe, lower valuation stocks. And that's what I'm going to cover in the videos that you're going to be getting from us over the weekend. We're going to go into more depth about that. So check us out. Looking at some of those other usual suspects, you see Amazon down 2.7%, and Tesla down 6.6%, and of course, Google down 2.8%, and Meta up for a change, but just by a hair. So I think that stock was already overbeaten and possibly has shown up on people's radars as a quote unquote value play within that group of stocks. But if you start to look more broadly, you see, again, a common theme here, okay? The green that's on my screen that I'm seeing here, we see some in healthcare, and we see actually within the tech sector, the lone green stock that I'm looking at on my heat map back there is Cisco. Cisco up by 4.6% on the day. They announced earnings earlier in the day, and they exceeded estimates and they upped guidance, right? So Cisco traded up for the right reasons today. That makes you wonder, did all these other stocks trade down for the wrong reasons? Well, we're going to find out about that soon. Looking also across the board, I don't see it up there on my list, but Disney got a good spanking today. Disney missed estimates by far, and they got beat up as a result of that. So that's another thing that we have to think about for the day. There were no economic data. There was no economic data today. We may start getting some next week. We don't know. We're going to talk a lot more about that. But the bottom line is the market was really, really beaten down today. And it really does reflect a lot of growing tension that's out there regarding high valuations of these tech stocks and these fast moving growth stocks that really carried us for most of this year. And the fact that maybe the Fed will not be supporting those stocks with a rate cut next month. And by the way, those stocks are very, very sensitive to interest rates and, of course, what the Fed is talking about. So it's probably not surprising to see the market trade like this. In the big picture, let's see here. Where is the VIX? VIX is at 20 right now. And VIX at 20, the way I look at it, is high. Anything above 18 for me represents something that you need to pay close attention to. Although the general rule of thumb is 20 and above means you have a highly nervous market. And so probably not surprised to see the VIX trading over there as well. Not much in terms of the yield curve today. But you can find that gold was, gold's still right now trading, and it's down ever so slightly on the day. And Bitcoin is down 3.5% on the day. And cryptos in general are down 1.32%. So if you take a step back, it was a risk-off day. I just want to take this time to remind you that markets don't only go up. Markets can go down. In fact, it's healthy when markets pull back a little bit. And we have seen that in the growth sector recently, despite the fact that we have gotten some really, really good earnings and great earnings growths in this earnings season, which is not done yet. Remember, we still get NVIDIA next week. So there's still plenty that we have to look at. But this can be actually viewed as a sort of a healthy sort of rest for the market. If in fact the market is broadening in breadth and people are putting their allocations more broadly in other stocks that are high quality, that may not be these growth giants, but are high quality and better valuations, that's also a healthy sign. That means that everything is going to do better in the mid to longer term. That means tech will ultimately come back, but it's better when you have the entire market participating. So that may be happening. And as I said earlier, we're going to be covering that in more depth in our weekend releases. So it's a risk-off day. It's not a horrible day. 1.6% down on the S&P 500 is not a horrible day, but the market action was kind of ugly. It was pretty weak. And I'm sure there's going to be a lot about that this weekend. So I want to also take a step back and say, look, if you like this type of content, we drop these videos every single day. We have our daily bombs videos, and we have our market close videos, and our news flash, our bomb blasts, and we have our weekend content. If you like this type of stuff, do me a favor, click like and make sure that you subscribe. And if you have some comments, please drop them below, because we love the comments, and we are pulling comments, and we're going to actually start making some videos from our top comments that we get from the week. And with that, I will let you know once again that check in here with Truth Bombs, because this is where we drop them before the market ever figures them out.